Thank you, Nicholas. Good morning, everyone. Welcome to Carnegie Mellon. Welcome to AFT 25. I'm happy and delighted to be here with Nicholas to welcome you and get this conference started. I'm an associate professor of economics at the business school here at Carnegie Mellon. With Nicholas and Elaine Shih, we co-direct our secure blockchain initiative. And so it's just wonderful to be in an event that brings together faculty from across such a wide discipline of fields to study this kind of important topic. I'm really thrilled to be able to welcome our keynote speaker, and we're excited to host this keynote address on one of the most pressing issues in technology and finance today. How do we thoughtfully integrate distributed ledger technology and smart contract protocols into our economic and regulatory future? Our speaker today is uniquely qualified to lead this discussion, and I'm really excited to have the chance to introduce Teresa Goody Guillén. She's a partner at the law firm BakerHostetler. Teresa is a leader of that firm's digital and innovative markets team and a co-leader of the Web3 and digital assets team. She brings extensive experience in securities, litigation, investigations, and corporate matters, particularly concerning capital and crypto markets. Teresa is here today to discuss a pivotal moment in our global technological history, the fourth industrial revolution. Distributed ledger technologies and associated digital assets are integral to this revolution, fundamentally reshaping economic and financial systems, commerce, and our global economy, along with other technologies like AI and quantum computing. The challenge, as Teresa has highlighted in her work on this topic, is that the rapid growth in this area presents unprecedented opportunities and significant regulatory hurdles. There's a current lack of clarity in the regulatory frameworks that can be destructive to our growing industry. Rather than proposing patchwork solutions, Teresa and her colleagues have developed a structured methodology aimed at paving the path for crypto clarity, which I think she will give us some insights on this morning. So I hope you will please join me in welcoming Teresa Goody Guillén as she shares her insights on navigating this technological shift and creating a robust and adaptable structure for the future of our digital economy. Teresa, please welcome.
So good morning, and thank you, Carnegie Mellon and Advances in Financial Technologies community for the invitation. This is a university that is particularly well suited for this, as it never waits for the future to arrive. It helps design it, and that's exactly what we have to do today. So it is really a privilege to be here among technologists and economists, professors, students, and people who can really help us build where it is that we're trying to go. And so as I speak today, I want to encourage everybody to adopt what I call the Sophia Guillén methodology. She's my 4-year-old. So when I'm talking, Sophia doesn't wait for me to finish sentences or what I'm talking about to interrupt, and she doesn't feel the need to relate her questions to what it is that I'm talking about. So I encourage everybody to always adopt the Sophia methodology, so please do that while I'm speaking, and I'll share some other Sophia methodologies along the way too. So it does mean a lot to me to be here, particularly with the invitation of Dr. Chester Spat, who once tried to teach me statistics, and against all odds, he did succeed. So I did end up passing that course, and he also is proof that even the hardest equations make sense when you have a great teacher. So thank you so much. It's really a privilege to be here with you too, Chester. Now, Chester, I got to know pretty well with Chairman Harvey Pitt, former SEC chairman. And I worked with them together at the same time, and they really helped me understand different depths and perceptions of markets. And they really shaped how I see them now today and a lot of the work that I've been working on with my colleagues. Markets is behaving according to incentives and constraints that are embedded in their design. And so really focusing on the architecture and the constraints and the incentives that really shape behavior. And so we can make it so that fairness and efficiency aren't just accidents, but they're actually an outcome of the structure that we're creating now. And I think we're all particularly well suited to work together to do that. So I hope through this talk and talking through the way that I look at it more from a law perspective, you will bring to bear your expertise and your background and help work together with all these different perspectives to come up with some of the best solutions for where we are today. Because today we're really building an architecture that protects trust and it measures intervention. So the moment that, sorry, I think I pressed one of those buttons there. The moment that we're in today is, it asks this deceptively kind of simple question of how do we design markets that deserve our trust? And in thinking through this, one of the ways that we've been looking at it is taking a historical approach of how have we done this before, and developing an approach based on what we call modularized economic property. And so I'm going to unpack that a little bit as we talk through today. And the moment that we're in right now, where we're trying to analyze this, is a moment we've all been waiting for a decade. So when Congress finally was in the position to start writing some practical kind of digital asset legislation, and they didn't have artificial boundaries of what they could or couldn't do, but really looking at what is the right thing to do, I thought the dog just caught the car. And that's kind of, I think, where we are right now. So looking at that, it's some people in Congress, when I'm looking at what they're doing, it appears that they're standing in the driveway panting and staring at the car like, what do I do now? Some are grabbing at the steering wheel. Others are holding hearings to talk about and try and decide who gets to drive. And then many of those who took off driving just sped off in the wrong direction. And the rest of the world is already in traffic, and they're on their way to a different course. So welcome to the fourth industrial revolution. What could possibly go wrong? And so now we're trying to make trust programmable. And through that, what the focus has been on so far is a lot of decentralization, of removing human bias. But then when we think about it, humans actually wrote the code. So when we're thinking about this as removing bias, we really have to consider how we go about creating it, and the process matters. Just like the process to what we're doing now with regulation matters. So the fourth industrial revolution I see as a revolution in trust. And it is happening now, and it's happening very, very fast. And some people are not recognizing that it's happening yet, which makes it even more difficult to deal with something when you don't actually acknowledge it's occurring. So when we think about the first three industrial revolutions, and I break this down pretty simply, and go through a lot of the background and historical parts of it, because one of the things that it seems striking to me is that we're not remembering where it is that we've come from and what we've learned. And we're not learning from history. And that's one of the most important things to do, whether you had a mistake or you succeeded, is to learn from it. And we're going so fast now in the regulation, and that I'll talk about a little bit later, that I think leads to market failure. And so I think it's really important to look at what has happened before, how have we approached this before, what led to market failure, and then how do we avoid that now? And you don't start from scratch. We have a lot of different successes and failures to learn from. So the first three revolutions, industrial revolutions, really outsourced labor. So the first, as in mechanizing muscle with steam, right? Muscle into mechanism. And then the second, scaled production with electricity. So a labor of skill to more of systems. And the third, digitize knowledge with the computer, so labor of thought to computation. And each revolution kind of handed off more human effort to machines. So this one is different. This time we're outsourcing something a lot deeper. This is trust. So we're outsourcing trust to code. Now this isn't belief in a feeling, but confidence in rules and records and results. So we're teaching our systems to do what courts and accountants and gatekeepers used to do. So in a very real sense, we're making trust programmable. So some contracts that once needed a courthouse, now live in self-executing code. Not all, but some. Ledgers used to require auditors, and now they reconcile globally within seconds. And markets that used to depend on a middleman now coordinate directly through cryptography. So this is a change in governance. And it's important to recognize, I think, how deep that governance flows through our entire society. So, and what is governance? And I think it's also important, and I encourage everybody to do this as I call you to action to help this in explaining to Congress and the people who are writing the rules that are going to set the structures, set the incentives, set the behaviors, whether it's self-correcting or causes market failure, that this governance is really flows through, like I said, our society, and it aligns all the incentives and settles disputes. This has a very significant impact on how we're going to operate our daily lives, how our societies function. And this is really the deep plumbing of capitalism. So we're replacing this institutional trust that we developed to architectural trust. And I think we're in the perfect place to try to figure out how to do that. Now, when I say architecture, I'm talking about design decisions that become behavior. And so who sees what and when? Who can change what and how? What happens by default, even when nobody's watching? So going back to Adam Smith, he would say this is the invisible hand. Others will talk about error correction, and others efficiency, but it's really all the same kind of thing in that with the logic. If the signals are clear, then the system self-corrects. But signals aren't perfect, and there's always noise, and there's power, and there's human nature. So many times when I'm practicing, whether it's an investigation or a litigation or even transactional work, it's just you always come to, why are they doing that? And it's people do people things. That's it. So you always have to recognize the big introduction of human nature and what that imposes. So in the 20th century, we answered these questions with institutions. So exchanges and auditors and regulators. And now we're answering it with architecture. So this is transparency in rules and default rules that run when we're sleeping, settlement that doesn't forget it's immutable. And this shift is equal parts, I think, possibility and equal parts peril. Because innovation doesn't erase risk, it just rewrites where it lives. And so as risk moves, we need to follow it and understand where it is, where it comes from, and then how to align incentives. So the possibility is that if we design our incentives well, the systems can self-correct more quickly, and it can be more inclusive. The peril is that design isn't neutral. So code does often have an opinion. Every rule plants some sort of an incentive. So just because once enforcement itself becomes programmable, the way that we used to do things in our kind of old playbook isn't complete. So how do we govern a world when rules and software are the referees? When rules are software and the referees are algorithms? And how do we preserve flexibility and fairness when more of our lives are governed by code? So this is more of a civilized question that I'm asking than a technical one. And this is where law comes in, because this is where law has a job to do, I think. And it's a very old job, and the purpose of law is not to stop or suppress the change, but it's to civilize it. So it's to translate this kind of disruption into order and to give these new technologies and relationships a vocabulary. And it's to bring order to the chaos. So you'll see a recurring theme in my approach. I talk about the we, and this is the royal we, and what we've done before. So looking back at when there's been this kind of disruptive technology. And I break it down to a lot of basics, again, because I think that this is something, these are the core principles that I see being missed in our regulatory approaches today, and certainly our legislative approaches. So the evolution of law, it comes through these kinds of disruptions. So when there was commerce and there was bartering, and it just grew so quickly, then we developed contract law. And then when industrialization created new risks, then we have labor laws, and we have our securities laws, which I'll discuss a little bit more. And then when networks started to collapse and distance, and then with identity, privacy and data law started to evolve. And so law comes in to really what I think of as like civilizing it, bringing order to it. It gives rights and boundaries and responsibilities, and this is the same, this moment is the same. So because of information asymmetry, enforceability, and collective action, those are the constraints of markets, and that's where the securities laws came from. So I'll talk a little bit more about the 20s and the 30s and what we learned, and if you trace through the evolution of corporations and resource allocations, you can start to see the separation of ownership and control and how that started to develop and create different incentives and different costs, like agency costs with the principal who owns things, and then the person who's acting on their behalf. And collective action. So when there's a lot of people who own something, the ability for them to all kind of come together and supervise somebody else. So in considering design, so design isn't a strategy. I'm sorry, hope isn't a strategy, but design is a strategy. So this is something that I learned many times over in lots of different types of circumstances, and particularly in business. But I think as all of us can appreciate, it feels right now that the approach that a lot of the digital asset regulation is taking is more of this kind of hope strategy. And I encourage everybody to really focus on the design and the architecture. And we want to design, basically we'll look at it in a few different ways, with clarity and accountability and resilience. Does anybody have any questions yet? Yeah.
So One of the things by the way, great talk so far. I like the thoughtfulness. There's a thing that you mentioned previously, which is, law has dealt with a lot of the stuff in the past, and it's good to look at historical references. I'm gonna do I don't fully agree with what I'm about to say in a second, but just for fun, I'm gonna do a steel man here and be like, okay, if we can replace a lot of standard law, which essentially ensures things like, bilateral contracts are upheld with much simpler code, is it not a strict improvement? Much simpler, much more transparent, much faster code. Is it not a strict improvement upon that area of law? Obviously, we'll never be able to replace all of law for many reasons, because it's got to touch the real world at some point. But while you're living in the fictional world of blockchains and code, so to speak, as it stands today, is it not a strict improvement? Do we have to are there cases where we must insert law into this system as it functions? Does that make sense? I don't know if that's
No, it does. It does, and that's great. And do we want our law to have mercy or fairness or judgment?
Sure. That is one. Yeah, exactly. Or do we want to have law accidentally prevent innovation in the space where we could further simplify other parts of law that are currently very complicated to deal with stuff that now is dealt with by the technology itself?
And so that's where I think it's important to look at what the technology does and what it doesn't do, right? And so it improves some things, but it creates other risks. So in asking, do you want law to have, judgment or mercy or things like that, it's if your rules are just, or if your referees, are algorithms, right? As I was saying, and it just decides one way or the other, and it's binary. What about the exceptions to the rule? What about the human factor? What about judgment? That's not there. And so it does work in some ways, but then you always need something to correct when it doesn't have that judgment, or doesn't have that fail safe. So you can't just replace all of law with code, because then there would be no type of judgment to apply, right? So, but I think in some areas it does, but it creates that risk. So then you need the risk of some sort of oversight, or some things where there's a fail-safe. So I think it does improve things, but I think technology and law work hand in hand, and one it doesn't replace the other, but it kind of improves the other. But it's recognizing where its weaknesses are, where it creates risks for things that we don't want.
Thank you.
Yeah.
Hi. You mentioned that you think the current, legislative process is relying on hope in some circumstances. Could you just, as someone who's hearing a lot about Genius Act and Clarity Act and stuff, can you just describe some of the ways you think the act or the legislation process is getting it wrong, and what hope is being relied on, and how that should be changed?
Mm-hmm. So I grew up in DC, right outside DC, my whole life. So I lived in DC proper for a while, and DC is different than every place else. And I'm going to answer your question and just kind of give you a little bit of background. My dad, though, he grew up in Jeanette, Pennsylvania. I don't know if you know where that is, but it's not far from here. Yeah. So, yeah, go Steelers. We are huge Steelers fans. And I actually wanted to be a running back for the Steelers when I was a kid. True story. And my dad said I didn't have the build or the gender, and maybe I should consider being a lawyer. So here I am. No, DC is a much different place in the way that it functions and it operates. And there's some great things about it, and then there's some things that I wish, were a little bit different. And part of that is, the voices and whose voices get heard, right? And the more, the squeakier the wheel, which usually comes from having enough resources to make yourself heard. And so a lot of times you'll see different types of legislation being maybe outsized influence based on different types of lobbying efforts or who's involved, right? The bigger the player, the louder the voice. And so sometimes we see that happen. And then if you kind of hope that they're just altruistic completely and they're not looking at all at how they're how it might impact their businesses, which isn't the case because obviously a lot of them, the businesses, they need to look out for the long-term shareholder value. And so I think in relying on the private industry to just always come up and tell you the altruistic thing is hope, right? And I think that in the legislation that we're seeing now, the proposals, there's this outsized reliance on different types of influences, and I don't think it's as pure as what is the most efficient market structure, what is kind of best for the economy overall and for society overall, without taking into consideration any special interest groups or businesses. So that's kind of where I come from with right now. It's a lot of hope that everything that they're getting is, that Congress is getting, is purely altruistic. And that's a little bit of my perhaps almost 50 years in DC. So, but I am very optimistic. I'm a very optimistic person, and I do think that we are on our way and we can get there. I was actually very pleasantly surprised, and when Congress decided to kind of pull back a little bit, not just because the government shut down, but before that, to try and reassess where they're coming up with a market structure and talk more to our agencies, our expert agencies. You know, the SEC and the CFTC are experts in this field. And I've spoken at length and with different people at the SEC and did a fireside chat recently with Paul Atkins, the SEC commissioner or chairman, who indicated that he thought decentralization was a red herring. And I 100% agree. And that an ancillary asset is not something that we want to create in our legislation. And I'm going to break that down a little bit. So I think first, I'm actually going to skip ahead a little bit to talk more about what it is that the 29 kind of the 20s taught us that we should be applying today, and where I come up with the economic property. I didn't come up with it myself, in this whole process is really, a lot of it comes from Adolph Burrell, who was one of the main architects of the New Deal legislation. And so looking back at how this has evolved over time, there's always been these new ways of looking at economic property. And economic property can come in so many different ways, but here it's more of the corporation and how shares came to be. So originally, a person had a business and they were one and the same. And then they separated out liability. Liability separate, from the person. And it continued to grow. And then when it became so that people had their, they had their business and they started selling parts of it. So the ownership of that business became separate from the person controlling it. And that's really where the incentives were not well aligned in the early 1900s. And you can, I think, when I look back at it, I see that the incentives were not well aligned. And had they been, and we thought more carefully about our structure or architecture, that the 29 crash probably wouldn't have happened. It was really, the 29 crash was a crisis in information. That was before it was a crisis in liquidity. And so investors, they didn't lose faith in the markets, they lost faith in what those markets represent. And people were not getting enough information about what the company was going to do. People who had that inside information were trading on it. And that information asymmetry led to a lot of fraud and a lot of people losing a lot of money and everything that they had. And as the corporations started selling more and more stock, they became more shallow. And so you have all these owners, none of them know each other. They can't talk to each other. They don't really have any way to get in touch with each other and to coordinate and supervise. And so a lot of this information crisis, is what led to people losing a lot of money. So that's when the securities laws came into being, right? This was disclosure as a design. So that's the design in the 33 and the 34 Act. And so it didn't say that this separation of ownership and control, which I call abstraction, so abstracting economic property, they just created order to it and tried to make it more fair. And complexity is just part of our capital markets. And if you separate the ownership and the control, then you have to create visibility. So Adolf Berle, his big thing, he did this with Gardner Means, is that they showed that corporations weren't just personal enterprises, but they also ran on some public trust. And so that's where trust comes into play. And it's all about kind of this balancing and regulating of functions instead of forms, which is another thing that I think the legislation now does wrong, is it tries to just classify things rather than thinking about how does it function and what does it do. And technology is just, it's moving so fast, and we were just talking about code, it can reduce certain risks, and it can automate enforcement, remove the middleman, make fraud more impossible by design, but it creates new ones like hidden leverage or oracle failures, algorithmic cascades. So the risks don't disappear. They're just shifting and moving. And the difficulty with some of the technology and when things get so complex is that people need to really follow and understand and break them down to more simple component parts to understand what they do. Otherwise, things become so complex that people don't understand them to see what it is that they're doing and where the risks are. And so that's particularly true now with the code, is we have so much transparency, but is it actually intelligible? Does anybody actually know what it says? Can they understand it? I would say no. So is it really transparent? It could be transparent, but we need to do something to make it transparent. Transparent to the everyday person. So, and I am not a proponent of regulation. I'm a proponent of free markets and self-correcting structure. And I'm not a proponent of paternalistic government. I think everybody needs to be able to make their own decisions, but I also believe that they need to be informed. And so it's making it so that the everyday person can generally have an idea. Nobody is ever going to write code like some of you or understand these things like you do. And some people are never going to understand different types of legal principles the way that I do. But enough to make informed decisions. So this is kind of gets to some of the root of the problems where we are today. And in trying to analyze the complexities of the code and the complexities of our technology, I think we want to look at why do we even have regulation in the first point, right? Like why do the securities laws exist? And it's not just a security, there's commodities, there's then there's the different types, and derivatives. And they're all important because they have a purpose. And so when the securities laws, this disclosure regime came up with the information problem that we were having, that's what it was correcting. So disclosure rules don't just apply just to apply, right? The whole purpose is to fix something. So what are we fixing? And so to know what you're fixing, you have to know what you're measuring, right? And that's the problem with our legislation too, is we don't know what we're measuring. Are we measuring the right variables? It basically measures decentralization. Is that the right variable? I would say no. Because if it's not the right variable, then you're actually legislating market failure into your system, and your market structure is market failure. So with the securities laws, the definition of a security is over 30 enumerated different types of transactions and relationships. And one of those is an investment contract. And it's come to be generally accepted by many people, not myself, but others, that the investment contract is how you should analyze digital assets exclusively, and that it couldn't be any of the other over 30 types of enumerated assets that are a security. Now, and then just taking that, one of 30, and then with that you have a test, the Howey test, and there's various factors. And for one of those factors, one of those things that could impact it is decentralization. So 30 over 30, then you have one thing, and then you have either 3 to 4 factors, depending on how you look at it, and then one thing that can impact one of those factors now is the test. So I aver that that's not accurate and is a distortion of our securities laws. And if you try to apply that to the entire regime, it makes no sense. And it's measuring the wrong thing. So the House Clarity Act and the Senate bills, they're talking about, is it a security or a commodity? That's form, that's not function. And arguing over that isn't really the right question. So a token could behave like a commodity. So a commodity is something that's consumed like gas, right? It could be a derivative when it tracks some other asset's value. Or it could be a security with some sort of separation from the risk, from the control, and then it moves among those. Like, it doesn't necessarily have one or the other, and it can at sometimes have one predominantly more than the other. And so if we are measuring the wrong thing and solving the wrong problem, it's not bad faith. It's improperly posed hope and bad measurement. And this is what I think that we need to correct. And so in mapping the different risks and looking at what is the right variable, I think that we look to trying to figure out where the risks are. And we can also look at what are these things correlated to. Different tokens are correlate to different types of assets. So this isn't really new. We can look back at things. So this reminds me of how when I was growing up, my dad would always say, I'll tell you, these are all my mistakes. He would tell me all the things that he did and say that I could learn from his mistakes and I wouldn't have to make my own. Of course, it doesn't always work that way. But I think that this is one of those times when it's worth doing that. Given that he grew up in the Great Depression, I would much rather learn from his mistakes of him telling me than have to live that myself. So I think looking at the design flaws is really important so that we don't codify kind of market failure. So how do these tokens, or I'm sorry, how did does the decentralization cause market failure? So there's kind of this myth of it, I think. People say like decentralization is independence. Well, it's not independence. You're changing basically vertical reliance to horizontal reliance, and it's more dependency than reliance. So is it really independent? So how we're actually looking at decentralization is different. Now this isn't a question of is it good or is it bad, should you want it or should you not? That's not the question to answer for me. And it can be whatever you want, free choice. So I'm a big proponent of free choice, but if you have that, what are the risks and what actually is it? And so that's why I think it's important to kind of break it down. And decentralization first is defined in so many different ways. So it's become kind of like this proxy for virtue, it feels like, and stands in for safety. But it really isn't like a single concept. And if you disagree, just please speak up, because I want to hear your view. So it's kind of a dozen things that don't always move together. So you can decentralize nodes, but you still have centralized control. You can decentralize geography, but still concentrate decision-making. You can decentralize voting, but voting updates are still in the hands of just a few developers. You can decentralize ownership and still have so much information asymmetry that nobody really can see where the real power is. It can reduce some risks, like operational dependencies or single point failures, but it amplifies others, like hidden influence and coordination failure. So it might mean freedom for a network, but it can also mean anonymity with accountability. It can remove human bias, but it can remove human judgment. And it can mitigate some risks, or it can transfer and move them, but it doesn't actually erase them. So it doesn't eliminate risks, it kind of redistributes them. And even in decentralized systems, you're still, like I was saying, it's more of this horizontal dependency, because you're still relying on validators or miners for consensus, developers to maintain and upgrade the code, oracles to deliver real-world data, custodians and exchanges to provide access, and millions of other participants to keep the network functioning. So I don't know that it actually erases reliance or if it multiplies it, but it seems to likely do the latter. So it can become stronger, what we were talking about, but it can also hide weak points. So this is something that as it continues to develop, and particularly we start getting in decentralized finance and DeFi, where this can be similar to the derivatives risk that we've seen before. And when we had the loops of of reliance of leverage. And so you can exponentially increase your leverage in the same thing, particularly by the lending protocols. So if you stake one asset and you receive another one, you can usually stake that asset and receive back to the first one in a wrapped version. And you continue to do this until your leverage is just exponentially increased. And it's unintelligibly transparent because it's all on the blockchain, right? That's when it's open, when you can see it, and it doesn't go off chain. So being able to kind of identify where these things, how it's coming into play, doesn't mean that you shouldn't be able to use leverage, but there should be some guardrails, and you need some sort of fail-safe so that one kind of failure doesn't cascade into a systemic a collapse of the entire system. And I think that this is another important part of not scaling so fast that you lose accountability. And so today's distributed networks are just reminiscent to me of so many things of walking, back from even the first type of agency when, from being able to own part of a voyage across an ocean, in the 1700s, but not actually knowing anything about that or having any control. So from going from like this decentralization, and there's also this ancillary asset aspect of it too. So you'll hear in the Senate version, they have an ancillary asset. They create this new asset called an ancillary asset. But what that actually is we've always called it the subject of an investment contract. So giving it a new name and then calling it something else and then giving it a different treatment isn't particularly helpful, I think. It kind of confuses things and it calls something that was the subject ancillary as though it's indirect, and then it's treated differently if it's an intangible versus a tangible subject of an investment contract. So if you just start playing out what it means to take something, rename it for one particular thing, and then think that that solves some problem, I think is also hopeful. And so those are the things in the bill that I think are kind of a little out. Those are the things in the bills that I think lead to market failure. And so I'm talking about all the problems, so what do I think is a helpful solution? Is looking at the different factors of economic abstraction that actually cause some sort of behavioral concern, something where you might need intervention. And so once you have a system that isn't self-correcting, then that's when you need something to come in and temporarily help come back to equilibrium. That's regulation in my perspective. So there's kind of 5 diagnostic factors I see. One is like transferability. So how fast can risk move, right? The more easily it's transferred, the faster risk can spread. So transferability of an asset. It creates liquidity, and liquidity is good, but it also intensifies or amplifies contagion. Passive economic interest, or passive economic property. So who creates the value, and who are you depending on? Is your exposure, your risk, how far separate is that from the control? And that considers more of the investor, somebody relying on somebody else for their performance. And then limited enforceability. And this doesn't get enough attention, or really much attention at all, but can participants protect themselves? This is one of the biggest issues that I see. It's it's not a reason in and of itself for regulation or for intervention, but it is something that's important, and it comes to this marriage between technology and law, where each of them have a really important part to play. So if a system fails, can somebody obtain redress? In the traditional markets, rights are enforceable through courts and contracts. But in code-based systems, then remedies exist if the code allows it or doesn't. So what is the fallback? And limited enforceability, it doesn't mean fraud, it's fragile. Because code doesn't really heal a breach. What heals that breach? What do you get? And when things are so anonymous, can you identify the person who owes you a duty? Just because you create something, you put it out in the world, it doesn't mean that you don't have a duty. So, there are lots of legal duties that are ingrained in our society. There's, you have warranties for things when you put them out, whether it's merchantability, fitness for use. You have a duty to be a reasonable person and act with due regard for the safety and well-being of others and yourself. So there are all these duties. I can't just put something into the world and have it kill people and then say it wasn't me, it was this thing that I created. Because it all comes back to somebody has to create it, and there's a duty when you do that. And it can be in contract law, it can be in tort, it can be in services and products, like all sorts of different areas of law, or common law basically, ingrain in us these duties to behave in a society. Otherwise, we wouldn't be able to have a well-functioning society. And then the fourth is systemic dependency. So what keeps the system running? And if there is something that falls, does that cascade? Does it take down the whole system? And a lot of this, I think, is like further development and exactly how oracles are working right now. And I think that is something that's important, and I encourage people to help us have more transparency and understanding that, and any kind of guardrails, because oracles are becoming such an important part of our information system, and creating systemic dependency on oracles to get real data, true and accurate data. And then the fifth is basically limited collective action. So can participants participate? So you have, like a DAO or a governance system, and if everybody can't really coordinate, then it's not really governance. They're not really able to govern kind of collectively. So private ordering can't correct if that oversight cannot step in. So having 1 million people who are able, I'm exaggerating, but 1 million people, as a governing body, nobody really has the ability to easily or practically coordinate with others to have any kind of meaningful governance. And so we need something for that private ordering. It doesn't mean it can't happen. It just means we need to structure our market a little bit different so that it can self-correct and the incentives are aligned. And then there's modularization, and this is so interesting to me, I think, and this is what I think has gotten the legislators, regulators, and everybody so confused, is that it modularizes all these different interests. So before it was, you had to have voting and economic interest and enforceability. All of that was in one asset. And all of a sudden we've disaggregated it or modularized it. Now it's in its different component parts, and nobody knows what to do with it because it's security-ish, derivatives-ish, commodity-ish. So it's being able to recognize that these different interests can actually be separated. And this is something that actually Adolf Berle, again, he came up with, and I read it one night, it was like 4 a.m. about 8 months ago. And it was in a footnote, and he had come up with this idea of what blockchain just created in the 30s. And he said, we have this active property and we have passive property. And, active property being the control and passive property being the ownership. And what if one day we could have passive property interest in active property? So an ownership interest in control. And that's what we have today. And I thought how fascinating he thought of that like 100 years ago. And he said, I'll leave it for another generation because we're not there yet. And so I think there's a simpler way forward. And I think that instead of trying to come up with 400 pages of really detailed legislation, we could come up with something that does more with a lot less and kind of leaves it to some of it to regulators to work out how to be more nimble and work together. Because now that we have these things that all have the same type of properties, we need more coordination. Just like blockchain, it requires coordination. Distributed ledger technology, it's coordination. And so it's kind of difficult to imagine a regulatory or legal regime that doesn't require coordination when everything that it's regulating requires coordination across all these different areas. And so I think if you look at these financial systems and you take kind of a page out of the book of like banking, you have lots of different regulators and they're all kind of work together, and you have a primary kind of supervising, leading regulator. And then you have the other ones where they're important but not quite, they're not the lead. That's not the main, the asset doesn't have that main risk area where it comes to correct. And so it's all really based on kind of risk. And so if there is some passive exposure, information asymmetry, or a collection action problem, then that's where the SEC, that's where its kind of its strong suit is. And then if there's contagion with derivatives or leverage, and there's these kinds of systemic problems, then that's more kind of where like the CFTC takes over. And that's more of its expertise. And just kind of jointly working together, rather than just trying to say, is this, let me put a label on it. The risks, this is gonna continue to evolve. So it's not like we're ending here. And so I think if we start breaking things down to a little bit more of a function, it's going to be a lot easier to make it future-proof so that it can be applied, and we don't end up where we are today, where our system is so regimented based on labels that everybody moves offshore, and then the U.S. starts to get behind. And so this is something else I learned, obviously a lot from my dad, and I always think of it as this is measuring twice and cutting once. So, in carpentry, my dad, he couldn't afford the lumber, so that's why he said that he always measured twice. But in governance, it's not to waste or destroy trust. And so we measure abstraction and how far risk has drifted from control, and then you measure the residual risk, and then what hasn't technology fixed yet. And then, only then, do you act with proportion and precision and purpose. Because if you act too soon, then you kind of freeze innovation. And if you regulate too late, you repeat the 29 crash. And so through that measurement, residual risk, I think is the most important kind of takeaway and thing to hopefully further develop to figure out what are the best ways to help our regulators then with managing any kind of residual risk with the least intervention possible. So as I close, I want to kind of return to the question of mindset. So again, my daughter, Sophia, she, like I said, interrupts constantly. She questions everything. She refuses to wait for the end of any argument before she starts a new one. She already started arguing before she was even 2. Very, very solid, logical, linear, actually, arguments. But she demands clarity, not to challenge really as much as to understand. And she reminds me that the world is changing quickly, and questioning things isn't a disruption, it's more of a discipline. And so this is another one of her methodologies that I encourage, is really, it's staying curious and being interruptible, keep asking why, and challenge all of those assumptions, because those change. And so particularly as technology introduces new fixes, new changes, assumptions change. And we don't need perfect answers, but the process has to be very honest. And so what are we kind of like being called to do right now? And I think that it's all of us to work together with that SOFIA methodology. So economists, helping with us understand incentives and equilibrium, and engineers knowing how where code can sustain or subvert the law. Lawyers can help translate this complexity into some structure. Data scientists can ground debates in evidence, not ideology. And so I see this as something where we are best suited by working together with research and dialogue and coming up with a design, and we can help Congress and regulators. So I invite all of you and encourage and request that the thinkers and the builders and the teachers, lend your insight, your data, your ideas, so that we can help move this into a sustaining structure to take us through to the next industrial revolution. Thanks.
Time for a few more questions.
I thought that was a very interesting talk, Teresa. So one of the terminologies that we hear a lot from DC in the current era is tokenization, and we hear about this in various domains, even at the extreme basically as a substitute for securities laws, for example. Do you have any thoughts about tokenization and how it fits within your framework?
Yeah, and I think of it always as like, what is it tokenizing? And then what does that mean for whatever it's tokenizing? So I look at tokens and it always represents something. So it's what are the interests, what are the obligations, and what's associated with that. And so in some cases, it does impact, I think, the securities laws, and it can. Right? I think it can do so much for disclosure. It can automate on a continuous basis, continuous disclosure, and it could do it in a way that is intelligible and really take a lot of the disclosure requirements out. That was a different time for, ticker tape and stuff. So in some ways, the tokenization, it's really the technology of how what you can do with the tokens to really fix the problems that required the regulation in the first place. But it is interesting because the tokenization isn't end all be all, but it has a lot of potential. Yeah.
Thanks for the very interesting talk. My question is about how fast legislation is catching up with these technologies. Like we see new threats emerging every day, like we see new risks coming up. So oftentimes legislation is created for the current risks and current threats. So they get quickly outdated. So how do we keep legislation ahead of the game?
Yeah, I think it's by looking more at these functions. And I see I think I could write, about a 2-page bill that I think would solve this. I'm going to hopefully finish it soon and send it in, because I don't think we need a lot, right? And it's so that we can continue to be kind of nimble, and the way that you're nimble is not by putting all these prescriptive things into these, hundreds of pages of bills, but making it more kind of principle-based and then focusing on the functions instead of this, these labels. And then leave it to regulators, these, they're supposed to be experts, to be able to be more nimble and and move with technology. Because even, I totally agree with you, right now, what they're talking about, what Congress is talking about and looking at, this is, I think from 10 years ago, we've come a long way in 10 years. And so a lot of these risks, especially with the DeFi and the leverage, it's grown exponentially, the type of different, the leverage, and then how things, the concept of privacy and whether things are moving off chain, where there's, like a more of a dark pool, and whether that's even like bad or good, So I think it's principle based, and leaving a lot of it to be just flexible from the regulators, I hope. But they need our voice. We can have a loud voice too. That's the other thing that I think really taught me from distributed ledger technology is the decentralization of things. More people have a voice, and there's different ways to get a loud voice. It's not the same process it always was before, which oftentimes seemed like not a fair playing field. The deck was kind of stacked, and this seemed to level it in a lot of ways. Not every way, but a lot of ways. And so we can have a loud voice too, together. I mean, look at how loud crypto was for the election. Like, wow, right? That's crazy. Crazy good, I think.
Thank you.
I might selfishly ask one last question. And I want to go back to something Guillermo raised about the benefits of code versus law. Where do we see the limits? Like, one description of a lot of the economic incentive research in crypto is kind of a game of whack-a-mole. We redesign transaction fees on Ethereum to kind of allocate block space better, and what pops up is different forms of minor extractable value, which then impacts my business, say, if I'm designing automated markets. And so there's a lot of spillover of risks from some incentive designs to other applications. And then we redesign automated markets to deal with minor extractable value. It's just a continuation of trying to get code to address every risk that pops up in a weird way. And would we be better off with a simple legislative framework that could just apply liability in the correct spot and say, you're liable for this particular issue, you figure it out in a general way or not? Like, should we keep playing this game of code whack-a-mole, or is a legislative framework likely to just enhance this?
Yeah, I think like the principle-based, I think legislative framework would enhance it. And I think it's interesting because things are just moving so fast that oftentimes people aren't thinking everything through the way that they should be. And we do normally have accountability for that, the liability, right? So I think that that's such an important part of the market structure and the architecture that has to be included. And I mean, it doesn't have to be through a regulator. The government doesn't have to come in. But if you are liable, then you're going to be probably more responsible. Except if you think that it's so anonymous, you won't get caught. And so that's like the careful balance. And it is difficult. And I think it comes with optionality. And so as I'm like thinking through things and talking to Congress about these different options, it's like you want people to be able to choose. Is privacy, for example, more important to you, and anonymity? But if so, then there's certain risks associated with that. Like you should be able to choose what is more important to you and have that kind of autonomy to make those decisions. But then then the structure, you have to have lots of different structures to apply those incentives. And I do think that clarity and accountability and enforcement are so critical for any structure to work. And yeah, the smart design of it. So hopefully some of you technologists can help create it.
Thank you so much, Teresa. Please join me in thanking Teresa for her speech.
Thanks.